Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today's Monday, September 8, 2014. Looking at a daily chart of the SPY. And boy, is this some market. It just won't go down. Not that I'm wishing it down. It's just we're in a time period where it should be going down. But nevertheless, so let's talk about what I see, and let's see if we can't resolve this and kind of map out a strategy here. So here's what you have. This is a daily chart, right? And you're chopping along sideways. So this is one of two things. It's either sideways consolidation getting ready for another move higher, and there's a reason why I think that may be possible, or this is what's called a rolling top or distribution, which means that the large institutions are dumping shares little at a time each day. They're dumping shares, and that's why on a daily basis over the last few days we've seen, a down move in the morning and then a float up in the afternoon, or at least some kind of down move during the day, and that's the institutions dumping out stock to the general marketplace. So one of those two things is happening: either the rolling top, which goes down, or the sideways consolidation, which is building pressure to go up. Now, the only reason that I can see why it would go up from here would be one thing, and it's in today's blog post, and it's about the Alibaba IPO. And here's the deal. The Alibaba IPO is the largest e-commerce company in China, okay? And basically, it's putting competition. Once they get name recognition here in the U.S., they're going to give eBay and Amazon and other e-commerce platforms a run for their money. They're going to take market share away, most likely, okay? And what happens is, since this is one of the largest, or I think the largest IPO in history, it's $20 or $21 billion. It may even get expanded by the time it comes public, which is going to be on the 19th of September, okay? So they're going to do a roadshow between now and the 19th, a little less than 2 weeks, all right? And what happens is the big institutions, you have Credit Suisse, Deutsche Bank, Goldman Sachs, and maybe there's 2 or 3 other large banks, and then there's another syndicate of probably 25 or 30 other banks involved to some degree or other. There's book runners, and there's underwriters, and there's this and that. It's all nonsense. Basically, it's the 40 thieves taking the largest e-commerce company in China public, called Alibaba. Remember Alibaba and the 40 thieves? So that's what's going on. And they're not going to let the market, this is my opinion, they're not going to let the market collapse for sure before this IPO happens on the 19th, okay? They can't let the IPO get scratched for quote-unquote market conditions, all right? It's too much money at stake. What does that mean? The investment banks involved, okay, and I think 85% of the allocation is going to the top, 4, 5, 6 banks tops, 6 tops. So you have Credit Suisse, Deutsche Bank, and Goldman for sure, and the other top ones I'm not sure of, but those guys are not going to let the market conditions dictate a postponing of the IPO, because in the way I calculated it, and I'm not sure what their fee is going to be, but I know that the fee, if we think of in terms of Facebook and what the fee could have been or probably was on Facebook, we're probably looking at least a $500 million fee, okay, for all the banks combined. And if 85% of that money goes to the top 3 or 4 or 5 banks, that's a lot of money. They're not walking away from that money. They're going to push this IPO out. Therefore, it's my opinion that there's no way in heck that this market is going down anything substantial before this IPO comes out. You may get a down day or two. You may get 20, 30 handles on the S&P, but I think that's the ball game if it's going to happen at all. So the downside in my mind would be about 1960, 1970, anything less than that, and look out below. However, I don't see that happening within the next 2 weeks. Now what happens? The Alibaba IPO comes out, and then you have options expiration, which is that day. Okay, it's really on the Saturday after that, but for all intents and purposes, last day of trading for options is Friday. So you have options expiration. Okay, you have a quarter end, which is the end of September. You have the Alibaba IPO, which is going to suck a lot of money up in the market. All right. And in my mind, okay, that's the perfect scenario for the market to dump out following the IPO, the Alibaba IPO. And if you go back in history and think of a couple of other large IPOs, you can see where that type of scenario did play out. And the one that comes to mind most recently was 2007, which was Blackstone, which is the largest private equity company on the planet, and they went public. They basically cashed out, right? The partners of Blackstone cashed out. They cashed out to the general public, and then I think that marked the top. I don't think it hit anywhere near the offering price. Whether it's there now or not, I don't know, but for a very, very, very long time. Don't forget, that was the top of the market in 2007. So that's kind of a scenario that I could see playing out with Alibaba, and I know I spent a lot of time on this tonight, but I think it's worth talking about. So, all right, let's move on. Let's just go over to a couple other markets. Gold. Very important to talk about gold because I've been keeping you guys away from gold, saying that not ready, not giving the signal, not giving the signal. And you know what? It didn't give the signal. And now I think we have to go down and test this double bottom area here. And we've been talking a lot about the GDX. And I'm going to go over to the weekly chart of GDX. And guess what? We had the inverse head and shoulders. And the inverse, I'm just going to draw a rough line in real quick. Here we go. It was over here, okay? And I said, as long as we don't close a week below this line, okay, that head and shoulders, that inverse head and shoulders was in play, okay? Well, last week, Friday, we closed on that line. Well, you might say, all right, take the trade. And some people might have taken a trade based on that. And what would happen is they would have to wait this full week and stop out at the end of the week if they're actually playing this pattern. What we're going to do is we're going to see how this week closes, and if it closes back above the line, I think we have a game on. But if it closes below the line, I think we have, 22 to 20 ahead of us in price, and we can buy, one of these levels here, and we'll see what happens day by day, how it comes into those levels if it did. So that's the game plan in GDX, and it's a good thing we didn't pull the trigger because it didn't happen. The inverse head and shoulders is not playing out as it stands today. So that's the story in gold, or gold miner. Let's just take one more quick look at gold. This is GLD on the weekly chart now. Don't forget, you still have this potential for a higher high, right? A lower high. And what happens is, as long as we stay, this is that double bottom I just showed you on the daily chart, right? Over here, this double bottom at 119 and change is this double bottom here, okay, 119 and change. Actually, the exact number on the low is 119.42. Okay, as long as we close the week above that line, then this pattern can still be in play for an upside move. So that's where we are in gold and gold miners. Thought it was important to discuss. There's reasons why we take and there's reasons why we don't take trades. And you have to understand that you have to have the market signaling to take the trade. We don't wish our will upon the market. We let the market tell us what to do. I know I always say that, but I can't say it enough. The gold market didn't tell us to take the trade, and we didn't take the trade, and that should be proof in and of itself. USO, the oil market, okay? USO is still very weak, and I still think, and this is the weekly chart, I still think that we're going to come down and go below this pivot low here. This is at 34 roughly, and I wouldn't be surprised to come down to, maybe by 20 or 30 cents below that. But at least that's my target now. If we break that considerably, then you go to this double bottom. But that's a long way off. So we'll see what happens. It's still in a downtrend. The price of oil looks weak. Oil stocks look weak. They were weak today. And, when there's unrest going on in the Middle East and Russia with the Ukraine and all the geopolitical stuff that would typically push oil prices higher, when those things exist and in the face of that oil goes lower, then there's a problem with oil and it's going lower, and that's just the bottom line. So that's the way we're playing that. When the market signals a turn and it tells us it's ready for a multi-day bounce or more, we'll tell the members and we'll put out a trade. Until that point, oil's going lower. What else do we want to talk about? Well, you know what? I've went on and on tonight, and I know I spent a lot of time on Alibaba, so let's give it a wrap tonight. I'm David Frost, mystrategicforecast.com. This was another episode of Common Sense Market Analysis. Thanks for tuning in, folks.